1.5% from the all-time high, as you said. If you look at the multiple, that's down very significantly. So the peak was about 22.8 times forward earnings. We entered this year at a little over 22 times forward earnings, and now we're just above 20. And that's because earnings estimates have, over the last 6 months and over the last, 2 to 3 months have surged. So by going sideways, the market has actually been correcting the multiple. So if you look at a multiple chart and you said that was a stock price chart, you would say, wow, we're still very oversold. So I think that has created that sort of, entry point, look attractive, even being 1.5%, from the highs.
How sticky do you think that multiple compression is?
So I think that 22.8 probably was not correct and was too high. But the earnings growth rate right now, and most of it is really, it's due to AI, right? It's due to the build out. But you're seeing a growth rate that's likely going to persist in this mid-teens range. And if you look at it versus history, you've got mid-teens growth. You've had debt levels that, looking back over the last 50 to 75 years, corporate debt is very low. CapEx, of course, has gone up of late, but also relative to history is also on the lower end. So a 20 multiple, while I still think is on the higher end, I think it's something that could be sustained and potentially move a little bit higher from here as the year goes on.
Does that make you think that big tech has to lead on any kind of rally, any kind of upside, given the diminished expectations for growth due to the conflict in the Middle East?
Absolutely. I think this earnings season is going to be a very positive earnings season for mega cap tech relative to their stock prices. And so, mega cap tech has gotten hit hard. The multiples of some have gotten hit hard. And a lot of this earnings estimate revision higher has actually been from tech while the stocks have been getting hit. So I think as you look to this earnings season, I think you're going to see, growth rate in cloud that are going to be very attractive. I think the commentary about the outlook for that growth rate over the coming years is also going to be quite favorable. So yes, I think you need mega cap tech, and I think you'll get it.
John's been talking about this for quite a while. How much room do they have to keep increasing their CapEx spending, given the fact that there are some concerns by investors of exactly what kind of return they're getting, and frankly, the fact that they're becoming more asset heavy in terms of their overall model?
I mean, there's still a very large mismatch between the demand for compute and the supply, and there's likely going to be continued issues in terms of just building it, like actually just being able to physically get all the pieces to build the data centers to meet the demand. And so that's probably going to elongate the cycle. And so I think that in the near term, I don't really see any change to that CapEx outlook.
There's also been concern from some individuals, especially on the Federal Reserve, that maybe they can't do anything. They have to sit on their hands because of what is going on, given the inflationary shock of the energy story. And you actually think the Fed is going to cut this year. You still think that?
I do. So the market's only pricing in a 40% chance of one cut. I think we're going to see multiple cuts. And I think it's really with, I think core inflation. So presumably the end of the war will be there sometime in the next, coming weeks and months. And so as we get to the back half of the year, I think that the headline inflation numbers are going to be looked at by the Fed as old news. And they will have already seen the starting of the move lower in oil, and I think it's going to go a lot.
PPI 830.
Hope for, but is on the move down, and that core inflation is going to really be what is going to be moving lower, and will be the rationale for the Fed to cut. And I think that this AI, surge in you look at Anthropic's revenues, right? There's likely going to start to be headwinds or continue to be headwinds for the labor market. And I think that's going to be for years to come.
You think we'll see that this year, AI impact basically layoffs?
I think some of that impact in the back half of the year, but we're also going to be lapping tariffs, which I think is going to be very important for goods prices. I think the owner's equivalent rent is just on a downtrend, and based on the current data, should be on a downtrend for the next year plus. And then I think wage growth is certainly going to be under pressure due to that AI dynamic. So I think if you put that all together, we'll be looking at core inflation rates in the back half of the year that are going to be enough for the Fed to cut. And of course, you're going to have a head of the of the committee that is going to be quite incentivized to cut. He's only one vote, but is going to be quite incentivized to cut, and I think that could have significant influence.
Just to extend that a few steps further, you've got AI disruption leading to layoffs in the labor market, and the Fed chasing something they can't affect, cutting interest rates for a jobs market they can't change, right? How far are they going to chase that? Because arguably, them cutting interest rates will just accelerate further AI investment, no?
So historically, the Fed has been much more sort of backward looking, and I think one of the changes that they want to make is becoming much more forward looking. And I think with Warsh in there, leading, I think he's going to be much more forward looking. Now, what is the impact going to be? That's where it gets very murky, and likely the impact is not necessarily going to be there, but ultimately the goal is going to be to spur demand beyond what it would be otherwise. That's going to be a tricky.
I'm struck by the fact that it feels like this market's saying mission accomplished. I feel like this market is collectively on some sort of aircraft carrier with a huge banner saying mission accomplished, we're moving on. And at the same time, oil prices are going to be materially higher. I just wonder at what point higher inflation starts to really bleed into the calculus in a more sustained way.
So one of the interesting things, if you look at a chart of oil prices over the last 15, 20 years, oil prices today are the same as they were in 2008. Okay, that was during the spike in '08, to be fair, but the same as 2008. Wealth since 2008 has gone up by about sixfold, like 600%. And so the impact, while oil clearly has an impact on a certain segment of the consumer and a painful impact on that segment of the consumer, if you look at the consumer broadly, consumer spending is not really being impacted because of this wealth creation that makes oil prices on a relative basis such a
In-depth analysis and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings rate.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. With stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Jennifer Zapasadja in the Lesotho Highlands, and this is Bloomberg.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risks.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pushing higher by 0.25% on the S&P 500. On the NASDAQ, up by 0.5 on the NASDAQ. A 9-day winning streak. In the commodity market, Brent and WTI pulling back. WTI this morning down by 2%. Brent down by 0.8%. 98 on Brent. 96 on WTI. This headline just crossed in the Bloomberg terminal. Iran mulling pausing its Hormuz shipping to avoid derailing talks.
Yeah, this according to a person familiar with the Tehran's deliberations, as reported by Bloomberg News, saying that this maybe signifies this desire to keep talks on the rails to avoid escalation in any form as they continue to have ongoing face-to-face negotiations. A real question here about uranium enrichment, as well as reopening the Strait of Hormuz. Not open yet, nonetheless, not escalating the conflict further.
Well, exactly. This says to me that Tehran wants to have these talks. Potentially, as Reuters reporting this weekend, we reported that talks are potentially underway, but as soon as maybe Friday and Saturday and Sunday. So basically what they are going to do is hold back on any sort of maritime activity to make sure that there isn't an escalation. So keep things at this moment, the status quo, so the ceasefire holds. That at this moment would be viewed as a very pragmatic step for this regime.
That is contributing to the reset we've seen in this equity market, wiping out the losses since the start of the war. The S&P 500 coming into this morning, positive for the year. Supporting that maybe some bank earnings. And the bank earnings so far have been very, very mixed. From JP Morgan, from Goldman Sachs, Citi just crossing moments ago. Citi crossing seconds ago.
Yeah, and coming out with a beat for fixed income currencies and commodities sales and trading, coming in at almost $2 billion versus the estimate of $5.02 billion. Equity sales and trading coming in at $2.08 billion versus the estimate of $1.73 billion. Pretty much across the board, there was a slight miss on the banking side. The CEO, Jane Fraser, coming out saying services had an outstanding quarter. You're hearing that there is this ongoing right sizing of Citigroup, and that the bank is entering into its final phase of divestitures. But the real takeaway here, capital markets very strong, expectations were very high. For the most part, most banks are clearing those hurdles. The response in markets, though, has been a little bit more differentiated.
This is the early move in the pre-market. The stock is a little bit higher by more than 1%. Danny Berger's pouring through those numbers. We'll get to Danny in just a moment. To set up the next 60 minutes, we'll catch up with Alicia Levine of BNY Wealth following a morning of bank earnings. The Port of LA Executive Director Gene Soroka joins us as war in Iran weighs on global supply chains, and Stephanie Roth of Wolfe Research breaking down the latest inflation data. The latest earnings then, to wrap them up, we've heard from JP Morgan this morning, from Wells Fargo and Citi just moments ago. Danny has more. Hey, Danny.
Hey, John. And the story is trading very, very strong for Citi, posting $5.2 billion of trading for FIC. That comes just under the high watermark of a record they set in 2020 during COVID, but easily above expectations. Their equity business, which, keep in mind, this is much smaller for Citi, posts a record sum, $2.1 billion of trading. The estimate was for $1.7 billion. This is the first time in Citi history that we have an equity trading figure that's above $2 billion. Lisa did mention this. There is some disappointment coming around their banking revenue. That comes in at just over $1.7 billion. The estimate was for 2.1. But the big takeaways, and the reason you are seeing positivity for Citi, this was the highest quarterly revenue in about a decade for Citi, the best return on tangible common equity in 5 years from Citi. And Jane Fraser and the team go on to explain that they are 90% of the way to completing their programs around their back office, the regulatory reporting issues, something that they had really been hit through. So it's this transformation of Citi that Jane Fraser has been undertaking as CEO, and they are getting closer and closer to completing that. In the meantime, notching very strong numbers for trading.
Danny, great coverage this morning. We've seen those strong numbers for trading at JP Morgan as well. Citi up like 2% in the pre-market. Jared Cassidy of RBC is back with us for more. Jared, you had an outperform on JP Morgan, an outperform on Wells Fargo, an outperform on Citi. Let's just sit on Citi. The revamp under Jane Fraser, how impressed have you been so far?
John, it's very impressive. As you can see from today's numbers, the return on tangible common equity was lifted up to about 13%. As it was just pointed out on your program, this is one of the better numbers we've seen in quite some time. And she's done a very good job in divesting the unprofitable non-U.S. consumer businesses. The last one up is, of course, the IPO for the Mexican subsidiary. They have the anchor investors, so we should see that this year. They have their big investor day coming up in May, John. And I think you're going to hear a lot of positive commentary about the outlook for Citi at that investor day.
I was struck by the commentary that we heard from Jane Fraser, in addition to the positivity that you're expressing, and that the results most broadly did seem to demonstrate. She said, we're off to an exceptionally strong start in 2026. How do you pair that with concerns about what's going on with the Middle East, with some of the sort of warning discussions we heard from the CEOs of Goldman Sachs, JP Morgan, and beyond?
Lisa, it's a good point because, the first quarter was a tale of two quarters. When you think about coming into the year, up until the end of February, the quarter was very strong in many of the different areas for Citi and its peers. Then the breakout of hostilities at the end of February increased that volatility, particularly in the capital markets area. So there is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks like Citigroup.
You were talking about what's left in terms of the revamp. Jane Fraser said that the bank was about 90% of the way to completing the programs it established to fix back office and regulatory reporting problems as pegged by regulators a number of years ago. How different is the bank today than, say, 5 years ago? And how does that sort of set us up in the current environment?
I think it's very different, Lisa, because obviously you've had a change in leadership compared to 5 years ago. And I think that this leadership, led by Jane Fraser, is very focused on delivering the numbers and holds people accountable within the organization. And that's probably one of the biggest differences. And it's showing up on the bottom line. And so once they finish the complete revamp, as you point out, it's 90% completed. Once they finish it, then it's going to pivot from not a turnaround story, but to now it's a growth story. And this first quarter results really gives them a good jump on that growth story.
Joe, we know you're super busy this morning, so thanks for making some time for us. Joe Cassidy there of RBC, breaking down the results from Citi. Citi up on the year by about 8% coming into today, up again this morning by 1.6%. For stocks more broadly, finding a firmer footing of late with the big banks kicking off first quarter earnings season. Alicia Levine of BNY Wealth joins us now for more. Alicia, good morning. Good to see you.
Good morning.
This market's moved on from events in the Middle East. Do you agree with the direction of travel?
So we do agree with the direction of travel. We obviously remained concerned, but not willing to change our allocations because we felt that ultimately the damage that would be imposed by $120 oil for a long time would not allow this war to continue much longer. And so as a result, we came into this with a pretty strong economy, a good setup with fiscal support, all the refunds coming from the IRS this season right now. The labor market looking like it was turning a little bit. And so you have all the incentives on the corporate side for investing. And so when you put it all together, the view that perhaps the US could have grown at 3% or more this year was the narrative coming into the war. And so maybe you shave some growth off of that, but ultimately with earnings expectations at double digits, on March 1st, now 3% higher than they were, you have a situation where the fundamentals actually got stronger, even as we worry about inflation and as we worry about where this conflict could go on the left tail.
Difficult to get your head around that over the last 6 weeks, given everything that's happened, the outlook for earnings actually improved. It didn't deteriorate.
It did not deteriorate. It's really shocking. We tell clients, look, earnings expectations are actually higher than they were January 1st. It's not just driven by energy. I mean, that's the obvious one, that energy earnings are now positive. They were expected to be negative, but materials and the tech sector. So, the great partner to the S&P forward motion is tech earnings, and it's just been moved higher. The expectations moved higher. So the other thing that happened or didn't happen is that there have been no downgrades at all. And so that's the thing to keep in a look at. We're at the beginning of earnings season. You have to see, our input costs higher? Do we have to shave revenue on the expectations? Because that's what didn't happen. We haven't heard anybody bring earnings estimates down. So that's really the tension here. We're now at 15% expected earnings growth for 2026. Isn't it realistic? Because the margins are the highest too. I'm not sure that's so realistic. And that's where we would look for any kind of moderating force on this. So it's been a storm. It's been a month-long storm. It's been a 46-day storm, and a real question of what has changed fundamentally in the outlook going forward as a result of the Iran war. A number of people have pointed to leadership. To your point, the gains have come in profit expectations at big tech, at materials, not necessarily consumer discretionary. How much is this back to where we were at the same time last year when tech just reclaimed its leadership? Look, we had this conversation a few months ago where I said, look, I think tech can actually move higher into the rest of the year. Everybody's selling software. They're getting out of tech, getting rid of the queues because they see more interesting opportunities in international and more traditional, I call it the dirty industry. So materials and energy and utilities. And in the end, tech has actually done quite well since March 1st because the earnings power are there. And if you're worried about growth and you're worried about inflation, you flee to tech. And I think there's a little bit now of a two-way conversation. Are you being paid to take a risk in this sector? And the answer is yes.
The other thing that people were talking about earlier this year is the broadening out away from the United States to the rest of the world. We had BlackRock, Jean Pauvin, come on and say that he liked emerging markets. We had the same kind of commentary earlier this morning from Brian Levitt of Oppenheimer. How much do you expect the dollar to revert back to a weakening trend to allow that type of broadening out geographically?
So I think one of the most shocking things that's happened during the war is the fact that the dollar has not strengthened more. The dollar is essentially 1% higher than it was March 1st. One would have expected that the dollar would have strengthened much more based on the concern of the risk. So you have to say is, look, if this is simply a crisis-induced strength in the dollar and ultimately means there's downward pressure on the dollar, ex-US markets will do quite well. And I think we're in that place where we never thought the dollar was going to collapse this year, the way many folks did, but it does seem that it should have been stronger than it was, and it wasn't. So I'd say rest of the world looks okay. If you are worried at all about tail risk, then emerging markets and developed international are going to be the areas where you feel it first. You spoke about the bond yields here on the show earlier this morning. Global bond yields have sold up much more than in the US, and that is a concern. So I think you a little bit have to be careful about the, is this a trade or is this an allocation for the next 12 months? For the next 12 months, I still prefer this to be in the US.
Within the US, you like industrials.
I do.
Can you just tell us why?
Because you have incentives for, first of all, I think you have to think about this. What's driving the growth here? The AI build out is remarkable. What's happened to some of these energy providers and industrials is remarkable. You have stocks up 40 to 50% year to date. And that's because there are massive incentives to build from the tax code, but also the end user demand is there. And that story is still intact. That's why PMIs are positive. That's why, the ex housing manufacturing is positive because you are having this forward push. What got lost in this conversation is that we're really undergoing an industrial revolution. So we've all become geopolitical strategists for a month, but actually the AI forward push is moving forward. And so we see the reshoring theme and the AI build out theme as enduring for the next 2 years.
We've certainly seen that in the ISM. Some decent momentum in that data. Alicia, it's good to see you.
Great to see you.
Alicia Levine of BNY Wealth. Constructive and has been throughout this war. And we should give people a nod, tip our hats to the people who have been constructive throughout this war because there was a lot of risk out there and this market has reset big time. There's still a lot of risk out there, but this market has basically done a round trip.
And pretty much everyone who has remained bullish has pointed to earnings and earnings expectations that have risen during this period of turmoil. And we haven't seen guidance materially lowered. And I mean materially from where they were earlier.
We haven't seen the cuts, to Alicia's point.
Yeah.
We haven't seen the cuts. Now, are analysts just too slow? They're waiting for the management teams over the next months to do the work for them.
It seems like the actual management teams haven't been guiding them that way either, because you heard from the airlines saying that they're going to maintain guidance even with the potential hit from oil prices. So a real question about whether growth was just expected to be so much higher. And so now the actual outlook is pretty much the same as it was earlier.
Adding to gains this morning, we're up by 0.25% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Taking another look at Citi, we are seeing shares up 1.3% after the bank posted a beat on revenue and profit. Citi saw $5.2 billion in fixed sales coming in above estimates, while equities trading crossed the $2 billion mark, pushing the bank to its highest quarterly revenue in a decade. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And we are seeing shares of Global Star rising 9% in the pre-market. Amazon agreeing to buy the satellite operator for $90 a share. Amazon is aiming to compete with Elon Musk's SpaceX and its Starlink network. The deal is expected to close next year. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. Bit of an update as well on Kevin Walsh. We talked about that in the past 10 minutes or so. Is a hearing underway? Coming up soon.
That's according to Tim Scott, who of course is the chairman of the banking committee. So it's important what he says. And he says he's cleared all the hurdles. And now we will go to have a hearing for Kevin Walsh next week.
The latest details from Senator Scott so far this morning. Up next, we'll get you some morning calls. Plus, we'll catch up with the Port of LA Executive Director Gene Soroka as the war in Iran weighs on global supply chains. That's next from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda Ahmed, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets,
From the micro to the macro,
covering retail, entertainment, the business of sports.
the supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld,
And I'm Romaine Bostick, and this is The Close.
live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China. The U.S. government's view that this could be just a couple more weeks of pain. The timelines might not line up, in my view.
That was Rachel Ziemba of the Center for New American Security weighing in on the situation a little bit earlier. Your equity market update looks like this. We're positive by 0.3% on the S&P, up by 0.5 on the NASDAQ. In the commodity market, Brent and WTI trading softer this morning. WTI is down by close to 3%. Brent's down by 1.3, 98 and 96 respectively. That's the price action. Let's get you some morning calls. First up, Bank of America lowering its price target on Goldman to 10.50 after it reported earnings, seeing results that are likely to give investors pause. Your second call from UBS upgrading Tesla to neutral, believing shares are currently at a more reasonable level following the sell-off. And finally, Citi raising its price tag on Alphabet to 405, believing its first quarter results are likely to beat expectations. That name is up at a pre-market by more than 1%. Let's turn back to trade. The war in Iran weighing on shipping as the U.S. blockade of the Strait of Hormuz enters day 2. The Port of Los Angeles Executive Director Gene Soroka writing, it will take months to untangle global supply chains. The economic ripple effects are real. They are growing. Gene joins us now for more. Gene, a good friend of this show, and thanks for making time for us this morning, sir. Let's start with the economic effects, the ripples you're seeing. Where do they start? How have they started, and where are they going from here?
Good morning, John. An adage in our port industry is that for every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Now, there may be some fits and starts and some quick answers that could be delivered. But once the strait is open, there is a lot of work to do in the supply chain. We're seeing right now where vessel fuel prices have doubled over the last month and a half. And that carry-on effect to importers and exporters right here in the U.S. is happening today. They probably will simply pass on these costs to the American consumer and buyer.
So, Gene, fuel costs are going up. The length and duration of the trips is getting longer because they've had to reroute a lot of this stuff. We've seen diversions pop up in different places as well. From your perspective, are you expecting congestion as well? How lumpy are some of these arrivals going to be, and how complicated does that make life for you?
Each trade, John, is a little bit different. For now, the 46th day, you're not seeing a lot of traffic move from Asia to the Arabian Gulf. Red Sea and East Africa also disrupted. In the Trans-Pacific trade, the ship transits are fairly normal. We're seeing the regular departures and arrivals from Asia, but it's the ports that we share with those Middle East destinations that are becoming somewhat worrisome. Singapore, Kaohsiung, Shanghai, Korea, and then Japan ports. If this cargo continues to pile up at these locations, it may just simply get in the way of cargo that's more fluid, like that coming to and from the United States. I must say, though, with calls over the weekend and last night, the Asia ports are doing a fantastic job of keeping that cargo separated, so the fluidity of the trades that continue to move remains intact.
Gene, when you see individuals having to
change basically some of their supply chain routes because of what is going on. Do you see any of this sticking, even if the strait opens? We have a little bit more structural changes going forward.
And Marie, this is always an outcome of disruption. Once cargo finds its way to a cleaner or smoother path, it tends to stay in that way for some time. We've had troubles over the past years with drought conditions in the Panama Canal, the Red Sea security issues leading to drops in Suez crossings by up to 80%. More cargo now
Welcome to the world of decentralized finance.
Tuesday, April 14th, and this is what is topping our agenda. Stocks rally as the S&P recoups its wartime losses. Talks about peace talks lift the mood, but luxury stocks could Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Trying again, the U.S. and Iran are said to be discussing a new round of face-to-face talks ahead of the ceasefire expiring next week as both sides try to cement a longer-term truce. Oil prices falling on those revived hopes for an Iran peace deal, even with a U.S. blockade of the Strait of Hormuz now in place. And HSBC's CEO warns the conflict in the Middle East is beginning to dent global confidence. We hear exclusively from Georgia Henry on why he thinks the region remains resilient. Well, it's just gone 8 a.m. across the Emirates. I'm Jemana Versace in Dubai. Green on the screen this morning on anticipated to take place between U.S. and Iran. I should say, though, that this is not being confirmed neither by the U.S. side nor by the Iranian side, but plenty of media reports overnight, including our own, suggesting that there is a desire to push forward with those discussions. So that has been taken well by the market. Of course, on the flip side, we know that as of yesterday afternoon, that U.S. This morning, the read across markets is one, I would say, of relief and of risk-on sentiment. S&P futures not doing a whole lot, but the handover from Asia was pretty positive. And take a look at the European Open. The European markets wanted to open up about 0.4% higher as we head into the European session. And of course, that namely is on back on the prices, the price falls that we're seeing in energy markets today. Two key energy markets that we've been focusing on throughout the course of this